All right, welcome everyone to today's explainer. Today, we're demystifying a concept that honestly feels a bit like magic, but I promise you it's just pure, undeniable math. We are talking about how a small, consistent, seemingly insignificant contribution can literally build massive, life-altering wealth over a 30-year period. So forget the get-rich-quick schemes. We are looking at the actual data-driven blueprint to financial independence. So let's start with a really direct question. Can $100 a month actually change your life? In a world that is completely obsessed with instant riches and massive tech buyouts, $100 feels remarkably small, doesn't it? For a lot of us, it's just a dinner out, maybe a pair of shoes, or a weekend's worth of entertainment. It is so easy to fall for the myth that you need to be wealthy to even start investing. But what if I told you that this single $100 bill is actually the foundation of a complete financial fortress? $589,000. Seriously, if you take that $100 a month and invest it consistently, every single month for 30 years at an average 10% annual return, this staggering figure is exactly what it becomes. You aren't just saving money here, you are multiplying it. And today, we are going to walk through exactly how you can replicate this exact math in your own life. Okay, let's dive right into part one, the power of $100. Right. Before we even touch the technical mechanics of the stock market, we have to completely reframe how we view our spare cash. The biggest hurdle for beginner investors absolutely isn't the stock market itself. It's the mindset around what money actually is. If you only see $100 as spending power, as just the raw material for short-term comfort, it's going to vanish every single time. Instead, you've got to view that $100 as a seed. Imagine holding a tiny seed in your hand. It seems completely insignificant, but if you plant it, if you water it and give it sunlight, a green shoot appears. And over time, it grows into a massive tree that provides shade and security. Every time you invest, you are giving your money a job to do. You are quite literally planting a seed for your future self. Now you might be sitting there thinking, well, I don't have an extra $100 a month to plant. But the reality is, most of us actually do. It's just being siphoned off by silent wealth killers. Just think about your daily habits for a second. A $5 coffee every day? That adds up to $150 a month right there. Add in the food delivery apps, the unused streaming subscriptions, and those random impulse buys, and your future wealth is quietly draining away. If you track your budget for just 1 month, you will be shocked at what you find. Trade a little convenience today for a lifetime of financial peace. Find your $100. Moving right along to part two, the compound interest snowball. So, once you actually find that $100 seed in your budget, you've got to know the environment where it grows best. And that brings us to the absolute engine of wealth creation. Compound interest is essentially your money making money. Here is exactly how it works. You invest your $100 and it earns a return, let's say 10%. Well, the next year, you don't just earn interest on your original $100, you earn interest on the interest you've already accumulated. And then that money makes even more money. It creates this unstoppable snowball effect. It rolls kind of slowly at first, but given enough time, it becomes an absolute avalanche. To really show you the sheer mathematical force of this snowball, let's look at a tale of two friends, Emily and John. Now, Emily decides to start investing her $100 a month at age 25. John, on the other hand, decides to hold off. He waits until he's 35 to start investing his $100 a month. They both invest diligently until they retire at age 65. And they both get the exact same 10% annual return. And wow, this perfectly illustrates the heavy lifting that time does for you. Just notice the massive contrast in their final wealth. Over her lifetime, Emily only invested $48,000 of her own cash, but her final balance is a staggering $589,000. John, who started just 10 years later, invested $36,000 of his own cash, but his final balance is only $227,000. Think about that. Emily invested just $12,000 more than John, but because she gave compound interest an extra decade to work its magic, she ended up with over $360,000 more in wealth. Time is, without a doubt, your greatest ally. All right, part three, realistic stock market returns. Now, it is absolutely crucial that we ground this incredible motivation in actual historical data. Where are we getting this magical 10% return from, and what should you realistically expect over your own 30-year journey? Well, based on nearly a century of historical data from the S&P 500, which, by the way, simply tracks the 500 largest publicly traded companies in the U.S., the average stock market return is about 10% per year. However, we do have to factor in inflation, which brings the real purchasing power return down to about 6 to 7%. It's also super important to understand that the market rarely returns exactly 10% in any single year. You might see a 20% gain one year and then a 15% drop the next. But over decades, those wild swings historically smooth out to that steady, reliable average. What's really fascinating to see is how a portfolio actually evolves over a 30-year horizon. As you look at the growth, notice how the expanding area representing your investment returns eventually just towers over the flat line of your actual savings. In those first few years, your own savings make up almost the entirety of your account value. But as the decades roll on, the compound returns begin to entirely dwarf your principal contributions. By year 30, your own out-of-pocket savings are just a tiny fraction of your total wealth. The market is literally doing the vast majority of the heavy lifting for you. Which brings us to part 4, index funds versus ETF. So we've got the math down and we know the historical returns. But what exact tools are we using to plant your money in the market? Let's totally strip away the intimidating Wall Street jargon for a second. For most beginner and everyday investors, the absolute most effective tools are index funds and exchange-traded funds, commonly known as ETFs. Think of these simply as massive baskets that hold hundreds of different stocks all at once. Instead of trying to guess and pick the next Apple or Amazon, which honestly is incredibly risky, you just buy a single fund that holds a tiny piece of all the major companies. This gives you instant diversification. If one company fails, your portfolio is shielded because hundreds of other companies are still growing. You aren't trying to beat the market, you are guaranteeing that you will match it. Now, the crucial point here is just understanding the slight differences between these two tools. When we compare them, ETFs can actually be traded throughout the day, just like regular stocks, while index funds only finalize their price once a day at the market close. When it comes to minimum investments, you can often buy an ETF for the price of just a single share, sometimes even a fractional share. That makes it absolutely perfect for our $100 a month strategy. Index funds, on the other hand, sometimes require a larger initial deposit to get started. Finally, ETFs generally have a very slight structural edge when it comes to tax efficiency. But please don't get paralyzed by the choice here. Both of these are fantastic, low-cost vehicles for building your wealth. Let's wrap things up with part 5. Automating your wealth journey. Okay, so we have the seed, we have the soil, and now we need the rules of gardening to make sure your wealth actually grows. The single most powerful habit you can develop is called dollar cost averaging. I know, it sounds fancy, but it simply means you invest your $100 on the exact same day every single month, completely regardless of what the stock market is doing. When the market is booming, your $100 buys fewer shares. But when the market crashes and everyone else is panicking, your $100 automatically buys more shares at a massive discount. This naturally lowers your average cost per unit over time. And best of all, it completely removes the dangerous human emotion of trying to perfectly time the market. To keep this strategy humming along, you've absolutely got to guard against the 3 enemies of wealth. First step is fear. Market drops will happen for sure, but downturns are buying opportunities, not a reason to panic and sell. You have to stay the course. Second is fees. High-fee mutual funds and expensive financial advisors will quietly drain thousands of dollars from your compound returns over the years. Stick to those low-cost index funds and ETFs we talked about. And third is forgetfulness. If you rely on your own memory to manually transfer that $100 every month, you are eventually going to skip a month, and that beautiful snowball will start to slow down. So here it is, your ultimate step-by-step blueprint. Step 1, audit your budget today and find that $100 by cutting out those hidden wealth killers. Step 2, open a brokerage account. Ideally, look for a tax-advantaged account like a Roth IRA or an employer match program if you have access to one. Step 3, select a broad market ETF or an index fund. And step 4, automate the transfer. Set it up so that your $100 leaves your checking account the very day after you get paid, before you even have a chance to miss it. Because listen, building wealth is absolutely not an overnight event. It is a lifelong process of discipline. I absolutely love this quote from our source material. The slow-growing tree outlasts the quick thrill every time. True financial independence is laid down brick by brick, habit by habit. You do not need a massive salary, and you definitely don't need to be a financial genius. You just need to start small, stay steady, and let time and mathematics do the heavy lifting for you. Which brings us to our final thought for today. You now possess the exact blueprint. You know exactly where to find the money, you know the vehicles to use, and you know the automated strategy to execute the whole thing. So the only question left to ask is, will you act today or just feel inspired and move on? Be the person who looks back 30 years from now and says,
That was the day everything changed. Thanks for exploring this explainer with us, and happy investing.